When we take a look at moving average number 2, the 150-day exponential moving average, we see that a moving average crossover method can be effective in attempting to define a trend, but should be used along with other aspects of technical analysis such as chart patterns, candlestick charting, and other technical indicators. As with many trend-defining methods, this method works well when the instrument develops a clear trend, but are less effective when the market is in a trading range. When the price of the shorter-term moving average, or fast moving average, the 50-day EMA, crosses over the longer-term slow moving average, the 150-day EMA, it's an uptrend indicator. When the price of the shorter-term or fast-moving average, the 50-day EMA, crosses under the longer-term slower moving average, the 150-day EMA, it is a downtrend indicator. The duration of the trend will depend on the length of the moving averages. A shorter time period EMA will cross over faster and change a trend more frequently than the use of a longer period exponential moving average. When we take a look at moving average number 2, the 150-day exponential used alongside the 50-day exponential moving average, we see the 150 days in red, the 50 days in blue. In this case, when price alone crosses the 50-day moving average, it's supported by the longer-term moving average. This helps to smooth out this price action and give us a much more clear definition of the trend. In this case, we assume that the trend to be up as long as our 50-day is above our 150-day. And we look for areas to join the trend, as opposed to reacting to when price alone crosses over one shorter time period exponential moving average. When we use this example in a downtrend, we can see the 150-day exponential moving average and the shorter-term 50-day exponential moving average. When price is below the 50-day exponential moving average alone, it can be used to help define the trend. But two moving averages used in concert with the crossover helping to define the trend gives us a much better reflection of the prevalent trend. And we can assume that the trend to be down as long as the 50-day exponential stays below the 150-day exponential moving average. There's been a good example of how to use a 50-day exponential moving average and a 150-day exponential moving average to help define the trend. This will conclude lesson 3 on moving averages. In our next lesson, we'll go over lesson 4, technical indicators.